Then Raja joins us, and what we are trying to understand is, given what is happening to China, how does one reconcile the outlook on commodities, power, and the entire China-dependent companies? Nitin, it's hard to imagine what's happening in China. For a country which was stimulating its economy to get growth, is now trying to go the other way around. China is the factory of the world. What would be the implications for Indian companies given what China is trying to do on the power side, on the tech side, on the production side, on the environment side?
I think clearly, when you look at it from an India perspective, there are two elements to it, right? So one is, if you look at companies, let's look at the negative element first. If you look at a lot of companies who are dependent on China for some of their imports as such, right? So if you take, for example, China was the API factory of the world. So if you look at some of the pharmaceutical companies who are dependent on China, I think clearly there will be some disruptions which are happening out there, and or you will see prices of those commodities move up and so on and so forth. On the other side, you will also see from a perspective that if China is no longer in that build mode any longer, and I think they did that for almost 9 or 10 years, and a lot of that was financed through the government debt, local municipal debt, and so obviously that whole financial system is has cleaned up considerably, but there is yet enough and more leverage which lies in the system. So if they're moving in that direction, clearly that whole infrastructure led growth is going to slow down, which can have an impact in terms of the demand for steel and ferrous and non-ferrous products as such. So I think that will have an impact as far as commodity prices are concerned, which should see some element of softening if that were to happen. So, if you look at some of the base commodities, where China is a large exporter, you will see some supply disruptions, seeing prices move up. Where commodities where China has been a consumer as far as infrastructure is concerned, you would see some softening happen out there. From an India perspective, if you really look at it, I think it is okay. Another element before I get into the India perspective is that China has contributed for 25% of global GDP growth. Now, clearly, as China's growth is expected to slow down over the next few years, led by unfavorable demographics, this whole real estate boom unraveling, clearly you will see an impact on global growth slowing down as such. From an India perspective, we will have some element of benefit that will happen with some industries where China was a big importer and which were causing, so take tires, for example. Tires would actually should benefit from the fact that China will be less of a disruption as far as that business is concerned, and all peripheral businesses around that should sort of benefit as such. India will also be some element of beneficiary about, and what people wanting to diversify away from China. We are never going to be able to take huge market share because while manufacturing has been a focus in the last few years, I think we are yet a long distance away from trying to think that we will be a sizable sort of replacement for China. We will start presenting an alternative. Hopefully, if we play our cards right over the long run, manufacturing should emerge for India as a big potent driver of growth and employment going ahead.
The reversal in IT, I think, is also evident, and that absolutely amazes me. Kunal, just when it appeared that after a gangbuster move, IT was either slipping into a corrective mode or into a consolidation mode, the comeback in a Mindtree, LTTS, HCL Tech today has been quite impressive.
It's got to do with more these stocks in territories on their short-term charts. So last today morning when these stocks opened on a slightly sluggish note, many of the indicators like RSIs and stochastic etc. had come back into deep oversold territories where for example the RSIs for a stock like Mindtree and Coforge, they had hit just closer to 10 11 levels on the hourly charts. That's quite oversold in terms of the indicator front. So typically when we've seen that whenever the market gets into a stable mode And whenever these stocks say enter into oversold kind of territories on the indicators, you expect a bounce for at least 1 2 days. Now those bounce are the percentage of the bounce is going to be very very important to watch, because if it's a reversal of trend for these IT stocks, then they will have to break past about their at least the 3 day highs over the next 1 day, and that too by a big amount of volume candle as well. But if it's a bounce which is more to do with the mean reversion or correction of the oversold territories, then it could just be a very minor or a meager bounce for these names, where you might see probably 1 or 2 days of bounce, but they will probably retrace back towards 50% of the losses which these stocks had seen in the last 3 trading sessions. So we'll need to probably assess that which way the markets and the stocks are indicating, whether this is just a short-term a relief rally into these names, or whether there is a reversal at play. But yes, as of now, looks like that the setup of the market indicates that even the weaker stocks like metals and IT, these stocks are making a bounce back for themselves, as well as the stronger names and the ones which have been off late riding on high momentum. The the PSU basket overall, both the public PSC stocks as well as the PSU banking names. I think the momentum seems to be focused over there. So one can probably look at more of short-term trading opportunities, but as I said, probably depends over the next couple of days that whether this is just a short-term relief rally into the IT stocks or whether there's a reversal at play.
Right. Just looking at what ONGC as well as Oil India are up to, because ONGC has had a few good days off late, although today it may be a bit of an underperformer. But Oil India, the other crude sensitive, that also is holding out pretty well, along with the ride that we've seen in ONGC off late. With crude already, Nitin, at $80 to a barrel, and you've got the gas price hike as well, effective October 1st, that augurs well for both ONGC and Oil India, you think?
I think all companies who are in the upstream segment should benefit from the rise as far as crude prices are concerned. Or of course, October gas price is something which is not linked to it, but it's been in the works, and you will see probably two of those happening over the next 6 months. Is what my expectation is. So yes, it should actually help these companies in the short duration.